Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is The Talking Point, and it is Monday morning, March 11th. What we see this morning before the market opens is a sea of red. The market, is going through the bit of a consolidation. And this week, there's enough macroeconomic data to move the market in one direction or another. But I want to go over something from last week, if I may, and that was the payroll data. The payroll data came in, and it was, how do I say this, something for everybody, right? You had a stronger headline number, more than the market had expected. The market had expected about between 190,000 new jobs to maybe 200,000 new jobs. But what we had was a bit over that. And at the same time, we had the two previous months with downward revisions. But when we go under the hood and kind of the things that we're looking for that help the Fed, remember, the Fed is meeting on March 20th. So they have to have enough data before they go in there for their dot plot. They were going to have that at the March 20th meeting. But also for the statement is the tone from the payroll landscape. And we saw the unemployment rate climb to 3.9% from 3.7%. That is still healthy. However, as has been pointed out, we haven't seen a number like that in some time. That is to say, a higher unemployment rate. But the wages, which is something the Fed pays very close attention to, and I've talked about that in this call, the reason for that is when you have higher wages, one, people tend to spend more money, and that could ignite inflation. And people could be, well, we've got higher wages, we could pay the higher prices. And remember, higher prices is what equates to inflation. And so the other part of the story is that when companies have to pay higher wages, they want to make sure that they are not the ones stuck with that. They try to raise their prices, whether it is, in the services or in the capital goods. They try to have the final end user pay for it. Well, now the wages came down, and that was a positive, by the way, in this report. But overall, as we come into this week, one of the things that we are left with is a statement that Chairman Powell made when he was addressing the committees, the financial committees up on Capitol Hill. And this was actually when he spoke in front of the Senate, because usually the news is made when he speaks in front of the House of Representatives, not the whole House. I should point out it is the committee that focuses on the Federal Reserve and monetary policy. But this was at the Senate. And he made this comment, and he said, we are closer to a rate cut. That was really important for the market. And the market took that in. And in terms of probability, this is from the Fed funds futures market, they are looking more at June and July as the time for a rate cut, if in fact the Fed goes ahead and moves accordingly. So as we go into this week, we're going to have more data for the Fed to digest and the market to digest in terms of where inflation is headed and where it's been, obviously, because these are all looking back. And this week, we're going to have the February Consumer Price Index. Now, remember, this is a different vehicle than the Fed's preferred look at inflation, which is the PCE, Personal Consumption Expenditures Index, where most of the information comes from corporate America, comes from, companies, whereas the Consumer Price Index, the CPI, that comes from surveys. So that's the difference. Ostensibly, they all meet together with the same picture, the same narrative, the same story, but sometimes it is a little bit different. And we're going to be paying attention nonetheless, because the market is very much focused on, yes, when the Fed cuts rates. And by the way, how many rate cuts do we think that the Fed is going to offer the market and the economy, actually? But the market obviously is always obsessed about itself, and that is to say the market. So we're going to get that report on Tuesday. We're going to have retail sales as well. And this is extremely important, as everyone knows, because the strength of the consumer is the engine for the economy. The consumer represents about 68 to 69% of U.S. GDP. And what we want to see is the strength of retail sales. We saw retail sales slow down a bit, but then what we saw was that Americans were buying vehicles. And you know what happens when you buy a vehicle? To me, it's like buying a house. It's that expensive. You tend to slow down your spending on other discretionary items when you have a vehicle, because that becomes a very expensive monthly expenditures for the average American. Also, on Thursday, we're going to have industrial production, and that certainly is going to be important at the end of the week, the industrial production. Actually, that's on Friday, but also the Michigan survey on consumer sentiment. We have seen consumer sentiment starting to come down, starting to ease a bit from the higher numbers that we've seen recently. And it's attributed to consumers saying, I'm worried about jobs. I'm worried about the job market. And that's interesting, right? When you still have a fairly resilient job market, that consumers are saying that they're worried about it. So it's going to be extremely important. And now also one other thing, we say that the earnings season is over. And remember, we're looking at the fourth quarter earnings season from 2023. But lo and behold, we still have some important earnings releases this week. We'll hear from Oracle, for example. And Oracle is interesting because they also offer a very interesting snapshot of global demand. And we pay attention to what they have to say. Also, we'll hear from Dollar Tree. And for obvious reasons, we want to know how lower end wage earners, that is their market, how they are spending. And also, if they're seeing higher wage earners coming in. We tend to hear that from Walmart, for example, when they look at their credit card receipts of where are the people coming in from, which wage group are they coming in from. But sometimes we want to hear that from the ones that typically cater to lower wage earners. So that will be Dollar Tree. And Williams-Sonoma, which is at the other end. That's if you've got extra money and you want to get your kitchen all fixed up and glammed up. That would be Williams-Sonoma. We want to hear, again, are they seeing foot traffic? Are folks coming in? And always, this is after Christmas, right? So you're not expecting like a pre-Christmas surge, but we still want to hear what they have to say. It's important. Also, by the way, with 99% of the S&P 500 reporting in, we can say that what we're seeing is that 73% of the S&P 500 companies that reported, they beat for profitability, which is important. That's good news. And 64% of those that reported exceeded revenue projections. That's very important. And so it was basically a good earnings season, and especially as we had concerns going into the earnings season. One other thing that we found from the earnings season for the fourth quarter overall was that operating margins held up, and they were actually a bit healthier than initially expected, initially forecast when we went into that fourth quarter earnings season. And that's good because margins are extremely important for companies. That's how they make money after they spend for wages and provisions and so on. So that was very good news. One last thing about the tone of this market. This market remains overbought. We talk about that a lot, overbought and oversold. Markets do need to consolidate. It's healthy. It burns off some of the froth. And you want to see that. We haven't had much of that recently. Every time we thought we were going to have a consolidation, something comes along and just says, no, not yet. Well, we may be headed in that direction, but I want to point out that's what markets do. And the month of March, typically in terms of seasonality, just seasonality, tends to be dicier for the market. However, in an election year, it tends to be not 100%, but according to the historical patterns, a bit more dicier. So expect that if we do have more than just 1 or 2 days of pulling back, that is not, abnormal. That's what markets do. And that is actually seen by most of the technicians healthier for a market. You just burn off a lot of that extra froth, and then you start again seeing the market just kind of pull out of that. Overall, this market is very much focused on, as we all know, when the Fed is going to cut rates and how many rate cuts are we going to have. They're deciding that. They'll talk about it, but the Fed funds futures market, I want to repeat, is looking at the summer. I do want to say that some of the leading doves at the Fed are actually suggesting that maybe we have a pause after that first rate cut, which would be a small rate cut, absent, the economy going downhill very quickly or some exogenous shock to the economy, that, the Fed could actually pause a little bit. And again, for the market, what they want to see is a steady drip of rate cuts. So far, the Fed speakers are not suggesting that that may be the pattern that ensues for 2024. We will see, especially as the Fed gets ready for their March 20th meeting. Have a very good week. We'll be back next week. Thank you all so much. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.